Welcome to Insights. I'm Eric. Thanks for taking the time to watch this review. We're going to talk about the economy in general, the cycles that we're in from peak to trough, why the stock market's behaving as it is now today, and how it's been different in the past, and where gold fits in, and why despite the infinite credit and debt creation, gold is not currently not doing that well. It's continuing to remain in a frustration phase for quite a few months now. The energy bill, we're still waiting on that one. What's it waiting for? Why is it dragging its feet? Is gold being manipulated, or is there other things that are taking place here? So we're going to take a quick look at the economic activity composite, the EAC, and we're going to show you that where that pops up on the matrix. I'm going to find it here, and we're going to open that up. That's down in this section down below under the U.S. economy. You can find it in these boxes here. We're going to highlight all those. You can click the links and you can come up and you can see some of these charts that we're talking about here, and here's some of the subcomponents, not all. And we're going to talk about those briefly. So let's head back to the EAC. We can see that right now we have the computer highlighting the bull phases and the bear phases. The red are the bear phases. If we want to shift it over, here's the bull phase. We'll just leave it on the bear for now. We can see that the bear phases are red, and in general, in the past, prior to about 2018, or really it was about 2017, most bear phases of economic activity were marked by declines in the stock market or periods where the price at least struggled to move higher. During these bear phases, the gold market tended to do fairly decent. It still does that. And in general, during the bull phases, which are unshaded, the stock market did fairly well. In those periods that are unshaded, the gold market didn't do as well at times and during transitions. At others, it did okay. But generally, during the unshaded or the bull economic phases, gold doesn't accelerate as fast as when things are doing poorly. But really, we're going to find out in a minute that all this stuff is tied to confidence, and it's tied to how confidence is tied to what the government is doing in order to finance the economy or to keep the situation alive. But for now, we can clearly see that we're in a bull phase. This is unshaded, so we're above the zero line. And we're in an economic expansion. An economy is either expanding or contracting. It really doesn't matter what the percentages are. It's really going up or it's going down. And it's really the direction and the acceleration that's the most important. That's what the computer's focusing on. We're in an expanding, so the direction is up. We're losing some accelerations because the blue line is turning down. The red line shows us that we're above. And for now, the economy is on more stable footing. I wouldn't call it a V-shaped recovery, but it is an economic recovery. So that's going to be supportive to the stock market as long as confidence doesn't fail in the system. And what we can also see is that during the last bear phase, the U.S. stock market caught a substantial bid, and that's because confidence is starting to shift, and we're going to see that in a moment. That in general, in these past phases, both the stock market and gold moved higher because of the public's or investing world's reluctance to park in the public sector, which is the treasury bond market. They're starting to question the infinite payouts, of which we can take a look here. Quickly, we can see the debt levels or the credit relative to the income of our nation continues to rise. It reached almost over 400% in 2020. It's come down a little bit from then, but we're still well above the peaks from the Depression in which all hell broke loose. So this is clearly not sustainable. It reached a high of 381% in the 2000, the Great Recession, which everyone called the Great Recession, but these are still all tied to one another. We've rolled over since then until 2015, of which now we're clearly We're just issuing more debt in order to keep the system alive. And the market senses that, and the invisible hand recognizes that. So normally during a bear phase in the economy, they pull away from the private sector, but there's actually continues to be a bid into the decline because people are reluctant to get caught in the public sector. They want to park in the private sector because when the game of musical chairs is up, the private sector, assuming that there's not some sort of dramatic change in the way governance goes throughout the planet, that the private sector will have claims to the asset, whereas the public sector just has promises, and those promises are never going to pay off in consistent dollar terms. They are just going to devalue the currency, and they don't really want to own that stuff. So we can see the stock market has moved higher even during the bear phase. Now it moves higher during the bull phase of the economic expansion, whereas gold is slowing down like it tends to during the unshaded regions. It can still go up, it just slows down a bit during the economic expansion. If you're a gold bull, you're going to look for this to turn down and create another red box in order to then reaccelerate the gold rally again. And normally that would turn the stock market down, but this time could be an exception. We could see the stock market continue to rally up as nobody wants to own treasuries. There are other ways to look at this too, and this is just one aspect of the federal budget oscillator. Also shows where the government is hemorrhaging ink, and which is most of the time. And when it does do that, in general, the gold market does very well. And so we're in that red box, and the gold market is fairly stable. It doesn't go back. We can change if we change this, and I'll pull this. Oops, pull this down to. I got to get that over here, and I'll pull that down to another. If I pull it down here, we can see it more clearly how the red boxes represent periods of which you tend to have accelerations in gold. Some of the time, they're not as powerful. They're more counter trend rallies. And back in here, the gold market was fixed. But we are in a red box, so this is favorable to the price of gold. And it likely keeps gold at least in a positive backdrop for a while. But again, it really is going to be tied to confidence, which I've long said that everyone should continue to watch inside the matrix. We'll head back to the matrix here, and I'll show you where that is inside the trends tab. That's down in here. So line 103 and 104. You want to keep an eye on that stuff. And right now, this arrow just went back up, and it's highlighted yellow to show a direction change. And we can see confirmation of that right here, right now, where this red box has been lost as the red line jumps above the zero or hashed line right here. So we're in a bull phase of confidence. What I would caution is that it's not going to be a long block like this one. Inside these bear phases of confidence, there were small intervening what I call slivers of bullish confidence, fleeting bullish confidence. That happens all the time. This is likely one of them where you're going to see a varying size, could be 3-6 months. And then we're going to, at some point, restore the red box again, because the sum of the red box, despite these slivers, is going to be roughly the length of this red arrow. Could be even longer this time, because this was the longest bull phase on record. It's probably going to be followed up by the longest bear phase on record. But because we've entered a slight bullish sliver, and you can see inside here briefly, and maybe I can zoom in and you can see it a little bit better. When you see these unshaded regions here, you can see how the price of gold slows down briefly. And this is probably what's going to take and end the frustration phase. You're going to get up here, you're going to get a reaction, whether it goes, this oscillator reaches this high or it goes around to this level. It's not important to the magnitude of the rally above the zero line. It's really just the time slice. They're often very short, and they can be a little bit longer. We don't know how long this one's going to last, but as soon as it crosses over zero, the ball's going to go back in court in favor of gold again. And what we're going to have to probably recognize is that you could probably get the same backdrop we've had before. This red box will return. You'll have gold going up, and it is quite possible that the stock market will go up in addition to that. It really depends whether or not the confidence break has ultimately filtered through all the layers of the global economy, the periphery economies. If it hasn't, the bond market in the US can still catch a bid for a little bit while longer, maybe another year or two, before it ultimately gets challenged by the invisible hand, or what I call the wolf pack that roams the capital flows that roam throughout the world. It will challenge the US bond market, but it will be last in line. It is the point of where when it corners the US bond market, the game's basically over. So the question is how much time we have left. It's hard to say. It could be a few years, could be less, it could be a little bit more. But if it is, there is a possibility where the stock market will curl over. But I'm of the opinion that whatever we end up doing, even if the bond market yields are driven to zero on the long-term side of the bond market in the U.S., the stock market is probably going to continue to catch a bid, because none of the world's smart money is going to want to get caught sitting in the bond market when they change the rules. So right now we see that we're in that small sliver right now, and it's going to create something of a short duration, create a pause in the trend. You can see a general upward move, and then each one of these pops above the zero line. One here, they all caused a reaction in the gold market. I'm pretty sure that's what this is. At some point then this is going to end, so I would keep an eye on it, and I would keep an eye on it here inside the matrix, inside the trends tab, and I'd watch it right here. This is the number that you want to see. You want to see these go back below zero. When it does, follow the arrow will be down, and you will know that the phase of confidence has changed back from short-term bullish to back to the bearish side. When it does that, then things are going to get far more difficult. The gold market is going to start to respond to the upside unless they make it illegal to own gold, which who knows what they'll do, but assuming that they don't fool around with it, it probably resumes its upward march. Probably silver does better. All those things are going to be an escape valve out of the public sector. They're going to escape from the public sector, from the periphery economies, from Australia to Japan to Europe first, and then they're going to target the U.S. last. So really where we stand is the U.S. economy itself is in a up phase. How long it stays above? Well, it's usually they are a fairly sizable. It should stay above the zero line at least for another year, maybe two, but that doesn't mean that the gold market's going to get pounded. It really depends on gold's more of a function of confidence than anything else. So if longer the confidence remains bullish, or at least temporarily bullish, the more gold will struggle. And I suspect that really I don't see anything that will stop the stock market until we get too far along and it gets too far high up the dividend yield cycles, which will quickly go back to the matrix before I close this out. The dividend yield cycles here will get even lower, and they will be down so low that they will mimic first 1987 and then 1929, and then the market will reach the point where it can't go up anymore. We'll let you know when that happens. We're not there yet. We'll talk about that further, but that's where we stand. That's how the V-shaped recovery in the economy that everyone's heralding as the return to normal. It's really not a return to normal. It's just kind of a pause within a general deterioration that's still not done. And when I say it's not done, it's the outcome's going to be far more detrimental in terms of at least the U.S. economy and the Western economies than most people are even prepared for. If you have any questions about what we talked about, contact me back. If not, keep an eye on these areas, keep an eye on the dividend yield cycles, keep an eye on the U.S. economy, and keep particular an eye on confidence, especially if you want to know when the bond market is likely going to roll over again and when gold is going to move. So thanks for watching, and enjoy the rest of the trading day.